Welcome to this explainer. Look, if you've been watching the markets lately and felt like you're completely losing your mind, like you're watching two totally different realities unfold at the exact same time, well, you're not crazy. Today, we're going to unpack the bizarre reality of the 2026 economy. We're exploring exactly how booming tech markets are actively colliding with everyday economic struggles. It's a fascinating, almost contradictory time, and we're going to break down exactly why this is happening. Here's our roadmap for today. We'll start with the macro tech paradox, then hit the AI bull engine, geopolitics and sticky inflation, and the consumer exhaustion cliff. Finally, we'll look at some hidden dangers before wrapping it all up with the survival playbook. All right, let's jump right into section 1, the macro tech paradox. Take a look at this. It really gets to the heart of the paradox. We essentially have two completely different realities fighting for the exact same space. On one side, you've got this soaring, unstoppable technological momentum that's driving markets to historic highs. But right underneath it, aggressively pulling it down, are the harsh, deeply volatile realities of traditional macroeconomic headwinds. We can basically split this massive divide into two competing forces. First up is what we're calling system alpha. This represents extreme tech dominance, driven by massive investments in AI infrastructure and semiconductors that are pretty much ignoring traditional risk models entirely. But pushing right back against it is system friction. This is the gritty, systemic economic risk threatening global stability. Things like restrictive monetary policy, sudden geopolitical energy shocks, and surging wholesale inflation. These aren't just isolated trends, guys. They aren't actively colliding. So let's zoom in on that tech side in section 2, the AI bull engine. Just look at how capital is flowing right now. It's moving at a pace we've literally never seen, all funneled into one massive, unified goal: hyperscaler AI compute. And it's not just about software anymore. We're talking about the immense physical footprint needed to run it: advanced processing, high bandwidth memory, networking, and, get this, even dedicated geothermal power just to keep these massive data centers from going dark. The sheer scale of the money moving here is staggering. We've got Cerebras debuting at a $55 billion valuation and Fervo Energy raising nearly $2 billion literally just to power these hyperscalers. Micron is smashing past a $900 billion valuation amidst global supply chain shifts. And the big institutional players? Hedge funds are actively expanding their semiconductor allocations to 20% of their entire portfolios. Why? Because they're banking on this multi-billion-dollar tech ecosystem as their only real lifeline to outrun inflation. But here's the catch. This tech dominance doesn't happen in a vacuum. As the US scrambles to secure its physical semiconductor supply chains, we are witnessing something wild: a reverse brain drain. Elite human capital, the brilliant minds required for next-gen AI and medical research, are being lured away from historical migration paths to the US and aggressively recruited back toward China. We are talking NBA-level wealth being thrown at these folks, all against a backdrop of severe diplomatic tensions like we just saw at the Trump and Xi summit over Taiwan. Turns out, the ultimate resource in this tech war isn't just silicon, it's the human mind. Okay, let's flip the coin and look at section 3, geopolitics and sticky inflation. This inflation ripple effect we're all feeling, it is entirely systematic. Let's trace it step by step. It starts with step 1, a geopolitical shock hits, say the Iran conflict, which immediately constrains global fuel. Step 2, that supply constraint triggers a wholesale PPI surge. Prices just jumped 1.4% in April alone. Step 3 brings secondary seepage, where high fuel costs inflate everything in transport logistics. Which leads us to step 4, the terminal reality. Corporations pass those heavy costs right down the line, meaning skyrocketing prices for your everyday wholesale perishable foods like produce and dairy. And the brutal results of that entire chain reaction? A sticky, stubborn 6.0% year-over-year wholesale inflation rate. Let that sink in for a second. 6%. That is the absolute highest we've hit since December 2022. It's not a blip. It is persistent, and it's deeply structural. Which brings us to the central bank. This 6% reality completely traps them in a restrictive rate gridlock. Incoming Federal Reserve Chair Kevin Warsh is stepping into severe policy handcuffs right out of the gate. It's essentially like trying to drive a car with the parking brake permanently stuck on. The Fed simply cannot cut interest rates because they are strictly mandated to force that 6% reality all the way back down to their 2% target. You even have regional Fed presidents out there warning about potential rate hikes, not cuts, just to fight this. And that pressure leads us straight into section 4, the consumer exhaustion cliff. Now, we did see an artificially elevated bump in retail spending back in March, but let's be honest, that was largely padded by tax refunds. If you look closely at this drop-off, those refunds are completely tapering off now. Add in the high structural gas prices that just won't quit, and consumer money is flat out drying up. It's dragging sentiment lower and pushing us right toward a highly dangerous spending cliff for late Q2. But making this exhaustion cliff even steeper is a massive behavioral shift that nobody really saw coming. Systemic GLP-1 adoption, those new weight loss medications, is fundamentally altering consumer habits, creating structural demand destruction. We're seeing households using these meds slash their fast food and quick service restaurant spending by an additional 8%. When you pair the end of the tax refund buffer with this massive shift in dietary spending, entire retail sectors are about to hit a very harsh reality wall. Let's move on to Section 5, Hidden Dangers and Wildcards. First up is what we're calling the meme mirage, this crazy illusion of retail health. We keep seeing this massive, localized market volatility. Take GameStop, launching a mathematically impossible $56 billion hostile bid for eBay, despite facing an absurd $20 billion funding gap. Sure, it generates a ton of trading volume and flashy headlines, but it's a total mirage. It's completely disconnected from the actual structural ownership reality of the market. To really grasp what's holding the market up, look at this staggering imbalance. The top 10% of households own 87% of all household equity assets. 87%. Meanwhile, the bottom 50% own just 1% of the assets, even though they generate incredibly high, noisy trading flows. That creates a dangerously concentrated market where retail noise easily masks who's actually holding the systemic risk. And then there's the ultimate wild card, an unpriced tail risk escalating stealthily right now in the background, the MV Hondius hantavirus. Compared to our COVID-19 baseline, the metrics are frankly alarming. It's got a high contagion rate estimated at 2.7, but get this, it's estimated to be up to 50 times more deadly. What makes this a true black swan for the markets, though, is the government response. The CDC is surging staff deployments from 3 to 100, but public health officials are incredibly hesitant to mandate severe quarantines because of the massive pandemic-era backlash. It is a huge, completely unpriced risk. All right, bringing it all together in Section 6, the survival playbook. So with System Alpha's tech boom and System Friction's inflation clearly on a collision course, what's the smart money doing? Here's the portfolio blueprint institutional players are adopting. First, they're going long compute, aggressively accumulating core AI hardware and literally ignoring bubble warnings because it's their best bet to outpace 6% inflation. Second, they're shorting low-tier discretionary retail and quick service food ahead of that consumer exhaustion cliff we talked about. And finally, they're using protective strategies, like the Campbell Black Swan hedge, to mathematically neutralize fuel threats, rotating capital heavily into safe haven, non-discretionary agriculture. Which leaves us with one final, deeply provocative thought to end this explainer. How long can this market paradox actually hold? Seriously, how long can unprecedented capital flowing into the AI engine continue to outrun compounding 6% inflation, geopolitical shocks, and a totally exhausted consumer before these two systems violently converge? Because the divergence cannot last forever. Thanks so much for tuning in and stay focused out there.